This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, we're expecting a lift for Asian equities across the board following that US inflation print, the Wall Street session as well. But to the downside, you just had those Japan GDP figures really disappointing what economists had been expecting.
Yeah, that key CPI data, by the way, it seems like came out early. We're just hearing from the Bureau of Labour Statistics talking about the early release of the CPI and real earnings data, that they had inadvertently loaded a subset of files to the website approximately 30 minutes before the release. The Office of Management and Budget, the DOL's Office of the Inspector General have been notified of the incident. They're conducting a full probe into procedures and controls there.
Yeah, well, Haidi, certainly an early surprise for markets because we did see them pushing higher off the back of that record. We can't say that word enough today because we've got a lot of different indices sitting at fresh record highs. US stocks, one of them, a 23rd high for the S&P 500 for this year. How that's playing into the session today, well, you do have the Nikkei 225 still coming online to the upside, 0.8% today. We did see that rally really broad-based in the session. In Japan today, though, the focus very much on financials because we had a number of banks yesterday reporting better than expected or stronger numbers and stronger forecasts for the year ahead. What else is playing into the dynamic is certainly those GDP figures, as we said there, on an annualized basis, contracting 2% in the period ending March. That is a lot worse than what economists had been expecting for a contraction of 1.2%. And we are seeing softening coming into retail spending, business spending as well. That's the outlook for Japan here. Let's switch to Korea because we're actually coming back from an extended holiday, or a public holiday on Wednesday rather. The Kospi here pushing high 1.4% at the start. Again, that focus on the US inflation print, that softening, that weakness we saw in US housing and also in retail sales. What else we're seeing today, though, that focus in Korea is actually on how Korea is trying to boost its own stock market with a value up program that sort of mirrors what we've seen in Japan so far. And we do know the Korea Exchange CEO is planning to hold a roadshow in New York to really sell the benefits of that, Haidi.
Take a look at how we're trading. We're just getting the cash session started here in Sydney, but we're expecting some pretty strong gains here. But really the dual forces of what we saw overnight, but also still getting some benefits for Australian assets when it comes to the report suggesting that Beijing is soliciting feedback on a plan that would allow local governments to snap up unsold homes, and that would be a pretty ambitious step, and in fact one of the most ambitious steps that we would see if they were to take it to address the property glut and the broader property issues there. But take a look at the ASX 200. We're up about 0.3% there. The Aussie dollar is holding pretty strong, just under that 67 US cent level. We've seen some benefit of that in terms of that sort of China eco proxy there as well. And we are seeing that move across treasuries, and in fact Kiwi and Australian bonds are following those gains that we've seen in the early part of this session. Slightly less than what we saw in US treasuries where yields really fell across the board there, but we are seeing that move being tracked by Australia. We're also getting April jobs data for Australia out later on Thursday as well. We've also just heard in a speech being given in Hobart, the central bank, the RBA's Assistant Governor Sarah Hunter, saying that there is no quick fix to Australia's housing crisis. Of course, a country in terms of both rentals and purchases facing the worst housing crisis in living memory. Let's bring in Mark Franklin, who's a Senior Portfolio Manager for Asia Asset Allocation at Manulife Investment Management. Mark, great to have you with us, and such an exuberant reaction across markets and from investors, right? If you kind of strip away the headline number, the super core numbers still show that there's a lot of sticky inflation elements. This is still kind of the first encouraging sign that we've had across consumer inflation in 6 months. Was the reaction outsized to you?
Good morning, Heidi. We have to remember that for the period of January to March, we had 3 successive months of upside surprises in inflation, particularly that super core reading. So yesterday's print, which was a kind of non-event in the sense that core CPI was broadly in line, but critically services ex-shelter inflation really moderated to, I think, 0.2% month on month versus 0.8% month on month the prior month. That created some welcome relief for markets, and we started to see rate cut pricing move back towards 2 cuts this year from about 1.5. So from that point of view, the breaking of that upside surprise trend, it's not entirely surprising that risk assets performed well yesterday and reacted very, very favourably to the data.
If you say, though, that if you lift under the hood, that there's still a great deal of uncertainty, and certainly if you listen to the messaging from the Fed, from Jay Powell even this week, a higher for longer is somewhere that they're comfortable staying. How do you play this market at the moment? Do you sort of take advantage of the next couple of months of higher for longer before you then pivot?
I think we have to look at different asset classes. Equities look like they've got growing sentiment towards them. The corporate earnings season globally is tracking reasonably well. The GDP data and the growth data news has moderated somewhat in the last couple of weeks. And for the time being, if the market becomes a bit more comfortable with the short-term outlook for inflation, we think that risk assets sit quite well right now. One of the things that we've been contemplating at Manulife is to broaden out and diversify our equities exposure more globally. So diverting away a little bit from the US, more towards regions such as Europe, Asia, Hong Kong, China as an example. On the fixed income side, that's where we remain somewhat nuanced. We still want some exposures that are more inflation protecting, such as Treasury inflation-linked bonds, floating rate notes, and as well to counter that risk that inflation remains volatile and above targets, we continue to look for opportunities in the commodities and the energy space as well.
Yeah, that's what I wanted to ask about commodities, because we're hitting the highest in a year now, and certainly that does perhaps pose a new inflation threat. So how are you thinking about that risk, and also how you, again, investing around it?
For some time now, there's been structural underinvestment in some of the major commodities globally, and there was going to always become a point where that structural undersupply, new supply coming onto the market, was going to come into focus in spot prices. So look at copper. That's really roared ahead in the last few weeks. We've been signalling that copper has a structural supply deficit issue for the next decade. We didn't necessarily assume that the prices at the front end of the curve would rally just now, but it would eventually happen. We also like uranium as well because of the proliferation of AI and data demands, which is going to fuel increased interest in nuclear energy as well. So it's really a supply-driven story, which is now meeting a growing short-term demand pressure point. So we're looking selectively across the commodities complex, but because of our secular view that over the next decade or so, because of fiscal stimulus, because of geopolitical uncertainty, inflation will remain volatile, supply resilience will be tested. Commodities looks like it's going to be an asset class that will figure increasingly prominently in our portfolios.
What about other markets as well? Because Japan is, of course, one we've been tracking very closely and very sensitive to any sort of policy direction there. But we just had the GDP figures coming out, really undershooting economists' expectations. It is that story of weaker retail spending, weaker business spending. Do you think that could perhaps give investors reason to pause on that market?
It's a great question. I think the Bank of Japan is in a bit of a challenging spot right now. It's still not fully confident that inflation sustainably is going to reach its target, and so it wants to run monetary policy and financial conditions quite loose. But that then creates downwards pressure on the yen. And one of the reasons why households are really unhappy right now in Japan, and you see that in the GDP data, the lack of retail spending follow-through, is because of a sense of loss of purchasing power, because of a weaker currency, rising inflation. And so households and businesses are screaming for a tighter policy setting, but the policymakers themselves are concerned about inflation effectively tailing off quicker than they would like. So that's one challenge, and why we think that, yes, there might be some further incremental adjustments in terms of rate policy and balance sheet policy by the Bank of Japan, but ultimately it's going to be baby steps. And so at the same time, we don't see any particular catalyst for a re-acceleration of domestic growth. That is actually not such a bad situation for Japanese equities. A competitive yen fueled by a perception that the Bank of Japan is running much easier monetary policy than other major central banks should continue to attract flows into the Japanese equity market. But there's one cautionary caveat there. The Bank of Japan has been a big buyer of equity ETFs over the last few years. Those purchases are on pause now. As part of their policy adjustment, will they consider starting to dispose of those ETF holdings into the market? On a fundamental basis, it would make sense because they're sitting on quite large profits. Were they to become a seller into the market, that could definitely pressure Japanese equities relative to other equity markets.
Mark, I want to talk about some of the broader thematics, and one of them, and really top of mind at the moment, is industrial policy as national security policy. And some of the other things that are surrounding that, obviously, we've seen the proposed Biden tariffs. We've seen Australia's, Future Made in Australia policy, which aims to kind of mirror what we've seen with the Inflation Reduction Act. How do you invest around sort of these themes more broadly?
It's a great question. One of the things that we learned from COVID was that you can't always rely on your traditional supply chain setups to give you resilient supply. Exogenous shocks can disrupt. And then fast forward today, we have a geopolitically tense situation. The world is becoming increasingly volatile. And so countries and industries are looking to shore up their industrial base, make sure that they're more self-reliant, not dependent for critical products and services on overseas suppliers. And what that's doing is it's fueling a rising investment in strategically important industries by governments in their domestic industries. So that is creating opportunities for some of the smaller, mid-sized businesses in the industrial space, and for example in the US, which are benefiting from government subsidies, but also growing order books as those countries start to bring their supply either onshore domestically or to reshore back to friendlier economies and trading partners as well.
That was Mark Franklin, Senior Portfolio Manager at Manulife Investment Management. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Unsurprisingly, of course, today very much focused on those US inflation numbers, retail sales as well, and what that means for the outlook for the Fed. But you can get it on Daybreak Go on your terminal. You can also get it on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. What else we're tracking, of course, is just how the market's performing so far, and we are just mostly seeing moves here to the upside. But we'll have more ahead. This is Bloomberg. All right, taking a look at numbers for Japan's mega banks here. We had earnings yesterday from Mitsubishi, UFJ, Sumitomo, Mitsui, and also Mizuho Financial. And we're seeing actually pretty much downside for these three lenders coming through. Let's get more on this now, bring in our Asia investing editor, Russell Ward in Tokyo. And Russell, as soon as I saw these numbers coming online this morning, I was a little bit surprised, actually, given the record profits. And I was straight on the IB function talking to you about it, why we were seeing it. And you were talking about the size of the buybacks in particular, particularly for MUFG.
Yeah, that's right. It's strange, isn't it? Japan's biggest banks just post record profits and then forecast another round of record profits, and yet the shares fall. And really, this is because they're not sharing enough of these profits in investors' eyes with investors. Mitsubishi UFJ announced a buyback plan of 100 billion yen, and that's less than 1% of its outstanding stock. So one analyst said before the stock started trading that this would be a negative surprise, and he was right about that. Sumitomo Mitsui's buyback is the same size, but it has, as a percentage of its stock, it's a bit higher. So we're seeing Sumitomo Mitsui's shares actually rise a little bit. Also, its profit forecast was a little bit higher than expected. And then the third bank, Mizuho, they didn't announce any buyback at all, although that actually was pretty much in line with expectations. But we're seeing the shares just dip on that sort of disappointing news as well.
Russell, what's the downside risk in this set of results?
I mean, really, if you look at the results themselves, they're really positive, and the banks are in a really good position right now. With the weak yen, they've been expanding abroad, so the value of their profits when they're repatriated are higher in yen terms. And of course, the negative interest rate policy that banks really hated is now gone. So the prospect for more interest income at home have improved. But in terms of downside risks, I think one thing about the banks is that they are quite reliant on the buoyant local stock market to boost their profits. They've been offloading a lot of their cross shareholdings and booking gains on those. And the stock market reached a record high last quarter, but the rally has sort of stalled since then. And so sort of being at the whims of the market is a bit of a downside risk. And the CEOs yesterday also spoke in their briefings about the risks from geopolitics, which of course all companies around the world have to contend with. But the mega banks are certainly aware of those as well. But overall, I think the outlook for the mega banks is pretty positive, and investors should probably expect that they're going to come out to that fiscal year quite conservatively, and then the prospect of buybacks and more shareholder returns as the year progresses is probably something that they can look forward to.
You mentioned geopolitics, but what other sort of thematic stood out to you from the earnings? Was there any sort of notes that were made around, for instance, hiring trends or anything around other factors as well that would really be coming across the different lenders?
Yeah, I think one thing that the banks like to show off in their results was their ability to diversify away from lending, particularly on a global basis, and diversifying into different markets and also into sort of more fee businesses. So Mizuho's CEO was quite keen to point out that they've been doing very well in investment banking in the US. They've landed a lot of good deals there. So they're sort of diversifying away from those traditional commercial banking areas into other areas, and that's really important for the mega banks.
Asia Investing editor Russell Ward there in Tokyo. Well, the largest US crypto exchange, Coinbase, is zeroing in on potential demand in Australia's growing self-managed pension sector. Our finance editor Adam Hay joins us now with the details. So this is a significant portion of the market, about a quarter of the pensions market that we're talking about here in Australia. So why are we seeing this interest by Coinbase, and what are they trying to do about it?
Yeah, I think a few things, Heidi. But firstly, clearly the growth in Australia's pension fund system generally is attracting all sorts of new businesses that see the long-term trajectory of that growth. So that overall pie is growing. So wanting to get a slice of that pie are an increasing number of foreign funds. And here, particularly in the crypto space, what Coinbase are doing, and they didn't really elaborate too much on details, but they're clearly targeting the self-managed funds, the SMSFs in Australia. And they seem to have more of a higher propensity tolerance for risk in areas like cryptocurrencies, where the big institutional money managers that manage the majority of pensions in Australia have generally shied away from digital assets. They tend to be more interested in the traditional bonds, equities and alts, that kind of category. They tend to stay away from crypto. But clearly Coinbase want, and this exclusive interview I think showed that with their representative here in this part of the world, that they don't even need lots of trading. They need a customer to come in to execute and buy some crypto assets and then essentially just leave it and hold it as a proportion of their total SMSF portfolio. So they're not looking at lots of trading revenue here. What they're looking at is an increasing number of customers, particularly young customers, interested in building a crypto position in their pension that they can essentially just set and forget, leave it, maybe come back to in a few months or years and tweak it. But it's kind of using that appetite to build that out as a long-term component of their pension fund over time.
But Adam, as you mentioned, we've seen a lot of the larger pension funds shying away from assets like crypto. So is that sort of caution warranted, do you think?
Well, of course, it's no secret that digital assets, broadly speaking, have been in a very, very volatile asset class. We've seen that in a number of the drawdowns that we've seen in Bitcoin, but also in other cryptocurrencies. So clearly there is that element of how big a position do you want to take in the crypto market in something like a pension fund, which has obviously got to fund you in your retirement. So there is still some anxiousness and some wariness around making that position too big. And that's indeed what we heard from someone in this story who is a very well-regarded person who's on the SMSF Association that kind of looks after people who are doing these self-managed funds. So clearly that is an area of concern. But of course, Coinbase and some of the other big rivals in this space, the likes of Kraken, the big overseas players, but also the local players, BTC Markets and and some of those other local players clearly see the overall growth for SMSFs outweighing any risk associated with volatile prices in cryptocurrencies.
Finance editor Adam Haig there with the details on that story. More to come here on Daybreak Asia. This is Bloomberg.
Russian President Vladimir Putin has arrived in China on the first foreign trip of his new term. It underlines the importance of his relationship with Beijing as Russian forces press forward with a new offensive in Ukraine. Our Chief North Asia correspondent Stephen Engel is here with the details. And Steve, this visit is coming off the back of Putin making some key leadership changes that sort of signals he's really setting up for a prolonged conflict in Ukraine. So how important then is the timing of this visit, given that no
limits partnership.
Exactly.
Friendship. Yes.
Friendship.
Look, I mean, China is an indispensable ally for Vladimir Putin and Moscow as the war heads into its third year. No doubt, obviously. You need friends, you need finances, and you need firepower. But I'm not saying China is supporting that or necessarily supplying, obviously, the weapons that are needed on the battlefield. But there have been so-called dual-use technologies found on the battlefield in Ukraine that have come from China. Whether, I mean, I'm talking semiconductors, which are used in everything, dual-use technologies, ball bearings. Anybody who knows anything about war they need ball bearings for their machinery and the like, and other equipment and electronics. And obviously, he's going to go there and he's there. He's arrived at 4 a.m. The guy gets up earlier than we do here at Bloomberg Television. And so he's starting running, and he'll have meetings, obviously, with his No Limits friendship there, his friend Xi Jinping, before heading off to Harbin as well. There's the 8th annual Russian-Chinese Expo, but that is more symbolic. He's there to shore up support. And you mentioned he's bringing his new defense chief, who is an economist by trade, technocrat, and also he's bringing his central bank governor, which I think we're just going to talk about right now.
Yeah, I mean, he's certainly bringing both the brass, the new defence chief, of course, and as you say, the central bank governor. So does this give us an indication of, some of the wants from this trip?
Yeah, as I said, you need your finances straight. And right now, the biggest benefactor to Moscow is, of course, China. And there's been some rumblings, obviously, growing pressure from Washington on the banks in China not to fund some certain trade between Russia and China because of this concern that it could indirectly support the war in Ukraine. So we saw, of course, two-way trade between Moscow and China hit a record $240 billion in 2023. That's more than double what we saw in 2020. But we've also seen in the last couple of months a year-over-year increases, or actually year-over-year trade actually decline on a year-over-year basis. Russian media has been reporting that Chinese banks in late March began blocking payments from companies in Russia buying components for electronics assembly. That's an indication, perhaps, that there's some worry in the Chinese banking community at state banks not to violate, U.S. sanctions and the potential threat thereof of secondary sanctions coming from Washington and being cut off from the U.S. financial system. So again, there's a lot at stake, and we're hearing that perhaps they're bringing the central bank governor for one reason, to find ways perhaps to use smaller banks that are not tied to the U.S. banking system to help facilitate some of this trade. That's just one thing that's going to be likely on the agenda, as well as talks on the Power of Siberia 2 gas pipeline.
Our Chief North Asia correspondent Stephen Engel there having a look at that trip and what's going to be on the agenda. But take a look at how futures in Europe are opening up this morning. Of course, we saw that continuation, really, the reaction to the US CPI print in the European session. This is the picture as we see futures again setting up for another set of gains there. We saw the rally on the inflation and retail sales number. We saw really pretty hefty gains across the board. Watching the euro is topping the upper Bollinger Band there in terms of the year-to-date trend line. We saw a 4-month high for volatility in euro trading.
right, taking a look at the Japanese yen here this morning, you're seeing it actually holding onto the recent advance against the greenback here, though we did have the biggest drop for the dollar gauge overnight after that inflation print came through. Still, though, what could really test that dynamic is the Japan GDP figures, because they came out just a short time ago showing that the economy in Japan contracted in the first quarter, and that's as consumers, businesses as well, they started to really reduce their spending. Let's bring in our Asia Economy and Government Senior Editor, Brian Fowler. And Brian, we can get to the BOJ in just a moment, but firstly, the numbers themselves, it was a fair undershoot on what economists had been expecting according to our survey. What really drove that?
Yeah, that's absolutely right. The numbers were terrible. As you mentioned, business investment fell. It fell more than expected. Personal consumption also fell more than expected. Net exports were also a drag. So we got the really bleak result. And in addition to that, data for the fourth quarter of 2023 were revised lower to show no growth at all. So really, for the last 3 quarters now, we've had either minus results, contractions, or we've had no growth. So it's looking really bad on that front. And a lot of that is inflation, which is weighing on consumption, but some of it was also some one-off factors. We had the New Year's Day earthquake that struck north of Tokyo, and then we had disruptions to the auto sector in the Daihatsu group. There was a scandal over safety certifications that were forged, and that halted factory output at a bunch of Daihatsu plants. That's all back online now. So those are one-off factors that definitely weighed on growth, maybe more than expected in the first quarter.
Brian, when it comes to expectations for growth going forward, how quickly is the idea? I guess the premise that the BOJ will be able to move quicker from here?
Yeah, I think we can expect actually a pretty good bounce in the April-June quarter. For one thing, those one-off factors have all disappeared. As I said, the factory output in the Daihatsu group is back online. There's also going to be a pretty solid base effect. Just after 3 quarters of contractions or zero growth, we could expect a bit of a bounce there. And then, of course, we have these wage hikes that were decided late in the quarter, late March, which were much bigger than expected. BOJ has said a number of times that it expects consumption to start to rebound if and when we start to see an increase in real wages, and that would be the first time in a couple of years. If we do get wage hikes of 5% or more, that's of course a much faster pace than the inflation we expect this year. So that would be a pretty substantial increase in real wages, and that we think would boost household spending for the first time in more than a year. So I think economists are saying, in terms of the BOJ making its next move, well, we still think it's going to happen this year. There's kind of a mixed situation in terms of expectations for June or July, or maybe waiting until October. But I think when we see the second quarter or the April-June data for GDP, the BOJ will definitely get a green light to go ahead and move. So probably in the second half of this year.
Brian Fowler, Asia Economy and Government Senior Editor there. And we are seeing really green across the board, right, as we see record high after record high being set across global markets. We had a look at European markets before, and we have really Germany, France, broader European stocks at a record. We have both major benchmarks in the US setting fresh record highs there as well, on the back of these really the exuberance over the fact that specifically that year-over-year core US inflation was the slowest in 3 years, never mind perhaps some of the concerns over the stickier core readings. But this is a picture as we see gains continuing through the Asian session. The Nikkei 225, despite those concerns over the GDP numbers, we are still seeing upside there. The Kospi is really showing leadership, though, when it comes to Korean stocks, the benchmark rising there by as much as 1.6% previously in the session, on course to set that new year-to-date high on the closing basis if we see a return to those gains. We're seeing in particular gains for Samsung and Hynix as well. But really, it is that broad-based rally we're seeing across Asia.
Yeah, and Haidi, also going to be watching how China markets come online and also the return of trade in Hong Kong, because we've had tech earnings that are continuing this week. Baidu and JD.com reporting later Thursday. So far, the results are a little bit mixed that have come through. We had Tencent reporting a far better than expected surge in earnings. Rival Alibaba, we saw that profit plunge there. Let's get more on that now. Bring in Ronald Kung, he's head of Asia Internet Research at Goldman Sachs. And Ronald, let's just start with the two that are reporting today. We have had question marks really over how much their profits are going to be squeezed here.
So we had the mega caps reported so far, one or two of them over this week, and a few more coming. I think so far it has been solid earnings and broadly top line that came in line. This is part of our 4 themes that we expect for China Internet as we updated our 4 key themes in April, which is the fight back of the incumbents. And we have Alibaba, we have Tencent, all talking about games reaccelerating at Tencent, GMV coming back at Alibaba. The fight back of the incumbents are leading to, we think, revisions in top line or at least some expectations that the top line will reaccelerate into the rest of this year. And then into the second quarter so far, as we host our TechNet conference next week in Hong Kong, we have 160 companies coming. We expect this to be the commentaries around how the current economic trends, consumption trends are ongoing. And we've seen that parcel numbers have tracked ahead in the past 2 months. Parcels growing around 20 to 30% year on year in the recent 1 or 2 months. That means consumers are still buying. They're buying cheaper things. The average ticket size is coming down, but consumers are still buying. And therefore, on the front of expectations will be key to the sustainability of how China Internet and K-Web performance. China Internet has rallied around 20% year to date. While shareholder return is the other key theme that we highlight, which is our companies are buying back 5% at 9% of shares plus buybacks in terms of market cap. And so this could provide downside protection while we anticipate for how the next few months consumption trends into June 18th will head.
You mentioned that the return of the incumbents into the space, and I think we've got a chart here just taking a look at Alibaba and JD.com, for instance, and how much their revenue growth has really trailed their peers. But the expense of Alibaba to try and regain market share can come as well against JD.com, and they're really fighting against each other. So how much does this become a zero-sum game where both companies end up getting a hit?
Indeed, we see China e-commerce as a zero-sum. Overall industry growing, GMV at around 8%. Parcels are growing, I just said, north of 20%, but value terms around 8%. And within that, we have around 5 to 6 players. It's not just Alibaba and JD. There's also Pinduoduo and the short-form video platforms, Douyin and Kuaishou. And therefore, this year, what we see is the fight back of the giants. Alibaba talked about double-digit GMV growth in the March quarter. We'll see where the numbers look for JD tonight. But overall, we've seen a slowdown in some of the initial share gainers and a fight back of the incumbents within this increasing zero-sum game. But within that zero-sum, we see ad tech coming in. So with AI, with applications into helping merchants target the consumers more effectively, we're seeing ad tech driving and take rate increase in e-commerce. So that's one of our out of consensus views, that ad tech remains a key driver in China online advertising. And despite the competition in e-commerce, we're seeing upside to ad revenues from the applications of ad tech.
Zero-sum survival of the fittest, does that apply for who you would choose within the gaming space too?
So in gaming, we think the leading players continue to consolidate the market. And with applications of, we just talked about some of the AI applications, games is one of those. And we're seeing continued consolidation in that the top publishers are taking share within the China gaming market. So with Tencent, with NetEase, and with their upcoming launches as well. And so we're seeing this reacceleration in some of the evergreen titles, which are games that has been kind of launched for a long time, but with new monetization tools, revenues are coming back. At the same time, our companies are looking abroad, and so international gaming growth has reaccelerated this year with some of the titles which have been very popular and has been driving some increase in grossing trends in international games as well.
Ronald, before we let you go, I actually wanted to get your views, if you have them, when it comes to the future of ByteDance and TikTok. We're now hearing that, there's sort of various bits of interest. We know that as an entity, it's going to be a very hard sell and a very expensive sell, but there are sort of moves for interested conglomerates of buyers. How do you see this story playing out?
Yes, I mean, one of the fourth theme that we highlight for China Internet is that domestic landscape is actually increasingly supporting our platform economies well. So the domestic businesses are actually more well liked. We lifted China Internet verticals to most our preferred, with music, with rate matching, with recruitment, all of these players really performing year to date. But we're seeing a shift in investor sentiment into going global, and that has been some of the geopolitical concerns and scrutiny across Chinese or China apps operating in US and Europe and sort of the developed world. So there's been reduced investor appetite in taking views in these some of these global platforms, and we've seen some of the bans that has been proposed and passed. And therefore, we think at this point investors are more focused in domestic internet verticals, education names, and slightly less into companies with more geopolitical concerns. But in that case, we're still seeing more companies looking into growth outside of China, but looking to ASEAN, into South America, and these have still been key growth drivers for some of the short-form video platforms and e-commerce platforms.
All right, Ronald, thanks so much for your insights. That was Ronald Kung there, Head of Asia Internet Research at Goldman Sachs. And we're just tracking through the morning session so far, all about that reaction to the US CPI print, of course. And one thing to note is the Japanese yen actually strengthening beyond 154. It's the first time we've seen that since May 7 of this year. But we'll have more ahead on Daybreak Asia. This is Bloomberg.
Some of the political stories we're watching today. The US will send a delegation to Taiwan for the inauguration of President-elect Lai Ching-te. Washington says the visit is in keeping with its long-standing practice of sending former officials to support a democratic electoral process. Lai's election this year was a setback in Chinese President Xi Jinping's ambitions for more influence over the self-governing island. Singapore's new Prime Minister, Lawrence Wong, is warning of a riskier and more violent world as he officially takes the helm of the city-state. Wong says Singapore should brace for new realities as great powers compete to shape a new global order. He says Singapore will continue to engage with both the US, its largest foreign investor, and China, its biggest trading partner. Indonesia's president-elect says he wants the country to become the world's fastest-growing economy early in his term. Speaking exclusively with Bloomberg at the Qatar Economic Forum, Prabowo Subianto told us about his priorities when he takes over in October from Joko Widodo.
I'm determined to build on that foundation, and my core focus will be first on food security. Indonesia must be self-sufficient in food, and then energy security, energy self-sufficiency, and we are determined to bring down poverty in a massive campaign, massive effort. I'm determined to get rid of hunger amongst our people, especially the young. And in the end, we have to concentrate on processing our natural resources. We have to make a great effort in downstreaming and to industrialize. And all of this needs good governance. I'm determined to cut down corruption, waste, and with that, we are very confident, we are very bullish, we are very determined to bring this all about.
All very ambitious if you want to do it within your first term, which is 5 years. Can you achieve a growth target of beyond 5% in order for you to fulfill what you have set out to do? In my conversation with Bapak Joko Widodo, he said that he's laid the foundation, he's implemented all the policies, put in place infrastructure needed for Indonesia to grow at 7%. Can you achieve 7% or more in the 5 years of government?
I'm very confident. I've talked to my experts. I've studied the figures. I'm very confident we can easily achieve 8%, and I am determined to go beyond.
8% within the 5 years, the first year, second year, and when you go beyond, are you looking at double-digit growth?
I would say within 2-3 years, yes.
You talked about downstreaming. What are the other growth drivers for you? Or would downstreaming be key to you achieving 7, 8, 9% growth?
Downstreaming will take several years. What will be a growth driver in the first years will be our concentration on agriculture, food production, food distribution, and energy. We want to go green in a very quick way. We want to produce our diesel from palm oil, and this will be a very strong growth driver. You know, we import $20 billion every year for diesel oil. So can you imagine the savings we will have when we will switch to biofuel?
I want to touch on your spending plans. When you campaigned, you talked about how you want to provide free lunches, free milk for students, and some are questioning how you will pay for such a program. Can you fund that program if you're unable to perhaps raise the limit of your budget deficit beyond 3%? You've said you can.
We have studied this. We have, we studied all the figures, and we are very confident we can do that. We are very confident we can do that. And
while keeping your budget deficit at 3%?
Yes, 3%. And you know, the 3% is something arbitrary. Not many countries hold to that. But we have a tradition of prudent fiscal management. I think we have the lowest debt to GDP figure in the world, one of the lowest. And so now I think it's time to be a bit more daring within good governance.
Indonesia's President-elect Prabowo Subianto with Bloomberg's Haslinda Aman in Doha. And of course, we continue to really watch the situation when it comes to central banks, right? The big question, of course, is the inflation numbers that we had overnight. Does it really change the trajectory when it comes to the Fed? Because that obviously has huge implications for global and Asian central banks. And we're watching, sort of always expecting from the Philippines, right? In their decision, they're expected to really stand pat. And in fact, a lot of the sort of same challenges are really being played out when it comes to the Philippines, the fight against inflation, the weakness that we've seen, of course, in the peso as well. Although I will note, with kind of the moves that we've seen in the US dollar and the resetting of Fed expectations, potentially we're getting to a point where some of that reprieve is coming for Asian currencies. In terms of what economists are expecting from the Philippines rate decision, all 26 in a Bloomberg survey expecting them to leave the rate steady at 6.5%. That would be a hold for a fifth straight meeting. The inflation, the most recent numbers, quickening for a third straight month within the 2 to 4% target, or goal, I should say, but higher food costs are really starting to weigh here.
Yeah, and Haidi, you mentioned the weakness we've seen in the Philippine peso. Of course, if we continue to have that direction toward Fed cuts, perhaps that sort of eases the pressure on it. But when you take a look at where we're trading right now, it's near that key 58 mark at this point in time. And so that does really constrain the actions of the BSP. Peso as well, more context on that. We're actually looking at a drop of around 4% over the course of this year. It has been Asia's worst performing currency this quarter. There's not just the Fed dynamic playing into it. There's also also territorial tensions that are playing out between the Philippines and China. So it's just some of the different things that we're tracking here. But Haidi, certainly one of the decisions that we're tracking today, and also a big interview coming up tomorrow.
Yeah, and we'll be able to talk about, whether that weakness in the currency is limiting the options of the central bank, right? Straight off the back of that rate decision, we'll be speaking exclusively with the BSP governor, Ila Ramonola. That conversation is happening at just after 9 a.m. in Hong Kong. That's 11 a.m. if you're watching here in Sydney. More ahead on Daybreak Asia. This is Bloomberg.